Welcome back to the Pursuit of Progress podcast. As always, I'm Adam Lang here with my co-host Ben Adams, and today's topic is going to be all about bridge loans, how they can help buyers secure their next home before selling their current one. So a problem for a lot of people right now is just how they're feeling stuck because they can't buy that next home until they sell their current one. So these bridge loans provide short-term financing that oftentimes allow homeowners to tap into their equity to buy before they sell. So today we're going to cover these bridge loans, what they are, how they work, who qualifies, and also just when they really make the most sense, as well as just talking through some of the risks involved. And Ben's going to share a few real world examples. So really excited to have Ben go in depth on this since this is in his wheelhouse and something he deals with on a daily basis. So with that being said, Ben, welcome back, buddy. How are you doing today?
I'm doing great. Really excited to be back. I think this is something that's really important, especially in our market, Denver, Colorado, because we have a lot of our homeowners here. If you've owned a home for a couple of years, you probably have record equity. And so how do you put that equity to work for you right now before you sell that property? So excited to share some stories. Also excited to share some personal stories on how I use bridge loans.
Awesome, man. Yeah, let's jump right into it. So, just starting off from the top, just for just anybody that is not familiar at all with what a bridge loan even is or what it means. So, explain just kind of a definition of the bridge loan and its main purpose.
Yeah, the definition and what a bridge loan is it's really a short-term loan that helps bridge the gap between selling your current home and buying a new one. So it's a way of accessing the equity in an asset, usually residential real estate, before you purchase a new home. So someone might have a bunch of equity tied up in their property. And in this Denver market that's so competitive, if you're writing offers contingent and you're competing with other buyers, well, chances are you're going to get beat out. So how do you make your offers more competitive when you're trying to purchase? Well, you do that through a bridge loan where you do that through a bridge loan because that'll give you access to use that equity and put it to work, to where you can use it to fund your down payment, your closing costs, even pay cash for the property if it's a big enough bridge loan. Um, and then use that to then go purchase your new property or your next property. Usually, bridge loans are shorter in term. They're meant for temporary financing, not permanent. A lot of times, the interest rates are going to be variable, and normally there needs to be a very strong exit strategy. So, either how are you going to get out of the bridge loan? Normally, that's done through selling the property and paying the loan back, or there are other options to refinance out of that we'll get into a little bit later. So those are kind of that's the overview of a bridge loan and how it works.
Okay, cool. Well, yeah, when I was reading through some of our notes before the episode today, I was really fascinated by last year a NAR report. So the National Association of Realtors had a report that said that 40% of home buyers right now are worrying about that timing of their sale and the new purchase, just being able to navigate kind of that juggling act. So 40%, that's practically half of all buyers right now. This is a concern and something that they've, reported as being a challenge.
And I think it's more pronounced in higher price markets like the market that we're in for a couple different reasons. Number one, homeowners, if you are a current homeowner, you more than likely have a significant amount of equity and possibly even record equity. So you want to be able to use, access, and utilize that on your purchase. But let's just say that you didn't have access to that. Well, the reason that you want to is because that's going to subsidize your down payment as well. And so if you were having to go purchase a new home and you weren't able to access your bridge loan, you would either have to wait until that property sold, or you would have to finance a much higher amount. And if you financed a higher amount, well, interest rates are higher. Your mortgage payment is going to be significantly higher then. Yes, you'd be able to pay it down after the fact, but is the loan going to be eligible for a recast? Not all loans are. So it just kind of complicates things. And at the end of the day, what this is really about is giving buyers more options. And when you have more options, you can make decisions that are more consistent with your long-term, medium-term, and short-term financial goals.
Love that. I would just be kind of curious, just you personally with your business, how often are you doing bridge loans? Is this something that's 10% of your volume is bridge loans, 5%, 1%?
Yeah, no, normally we will always, whenever I do a bridge loan, it's always in tandem with another purchase. And so, for example, I just helped a customer of mine who I've done, 5 or 6 loans for over the year. He's been trying to find the right property for his dream home, and he had a property in Erie, Colorado that he bought around 2020 and had record equity in that property, and was buying $1 million+ property, very financially literate, had his retirement account, uh, you know, funded, had some personal savings as well, but he doesn't necessarily want to dip into those other resources. And so that's how we got the conversation started about, using the bridge loan. And he actually already had a home equity line of credit set up on his departing residence. It just wasn't going to be enough. And that's a great strategy too. And that's why I believe if you have equity in your property, you should put a home equity line of credit on there just so you have access to the equity before you need it. Because if you do that, that can then function as a bridge loan. And instead of scrambling and trying to apply for a bridge loan and then also a new purchase all at the same time, you're better prepared. So that's the strategy that I actually recommend and suggest, is putting the bridge loan, i.e., a home equity line of credit, on your current property as soon as you have sufficient equity. And then not only can that function as a bridge loan, but it's also going to be, it can just a financial fallback. If there's ever, you have the ability to do that.
So, just to understand for myself and also the audience, a home equity line of credit is, I guess, a form of a bridge loan. However, there is an actual product known as a bridge loan that is different, correct?
Yeah, it's a good question. A bridge loan it can be a home equity line of credit. For example, at North Point, though, our bridge loan, which is labeled as a bridge loan, is really just a home equity line of credit. Now, we have built guidelines around that, but it's the same home equity line of credit that we offer as our standard home equity line of credit. To qualify for it, though, there are some guideline changes that are a little bit different than a normal home equity line of credit, but the loan to value restrictions, the debt to income ratio, the credit score requirements, as far as the qualifying guidelines, interest rates, everything else, are all identical. There's a couple additional overlays on that. Outside of that, though, it is the exact same. So you can, and that's what I was mentioning a minute ago, where a bridge loan is a temporary or intermediary loan to allow you to make that purchase before that permanent financing sets in. So it can be a home equity line of credit on something that you already have set up. And so that's where, if you do a little planning in advance and you already have the home equity line of credit set up, you can use that and it can function as a bridge loan. If you don't, there are options out there, like working with lenders like us over at North Point, where we can help you set up a bridge loan. With North Point, if you wanted to qualify for a bridge loan, you would actually have to have your home listed for sale prior to the transaction closing. So that's one of the big overlays and differences between a bridge loan and a traditional home equity line of credit.
That's good advice, or good to know. But I mean, if as long as you're using it properly, I mean, I don't see why that would ever be an issue, having it listed before you finalize the loan. Mm-hmm. So is it pretty, though, uncommon for somebody to do both? You already have a home equity line of credit, to be able to qualify to do another form of bridge loan. Is that pretty unlikely? Like, if you've set up a HELOC, home equity line of credit, most likely that's the only thing you're going to be capable of kind of utilizing in this scenario as a kind of a bridge between two different purchases.
Yeah, that's another really great question. And that's also why I recommend getting that home equity line of credit set up in advance of your purchase. And the reason for that is, if you do that, you're going to be qualified off of your current debt profile, based off of your existing first mortgage and what a home equity line of credit would look like on your existing property. On a bridge loan, they're going to take in that home equity line of credit on the property that you're going to sell, but then they would also factor in what that new mortgage payment would be on the property that you would end up, the one that you're wanting to buy. And so at that point, there's, it can be more difficult to qualify for all of that at once versus qualifying for its, one step at a time. Because if you do that, uh, it's going to be a little bit easier to qualify for than trying to do all of this at once. And so that's another great point. And that's also one of the risks as well. The fact that, if you are going to do a bridge loan, it's possible you could have 3 mortgage payments. If the property that you're selling is more than likely going to have a first mortgage. If you put the bridge loan on there, that would be the second mortgage. And then the property that you were going to purchase would be the third mortgage. So you want to make sure that you're very financially secure and that you have a plan in place, both with the purchase and then paying off the bridge loan.
Definitely. So just kind of finally kind of wrapping up this portion about just the eligibility and the approval process with this. So is there just kind of some kind of overall general, maybe a couple qualifications or just things to maybe share with everybody that's consistent with most, either HELOC or I guess a more of a formal bridge loan?
Yeah, I think that's another really good question, and I'll get a lot of questions from buyers that they make it sound like I'll just go get a bridge loan. Well, here's what you need to know from a qualifying perspective. On a bridge loan, you have to have a significant amount of equity, usually at least 20% equity on the property that you're going to sell. And the reason for that is if you have 20% equity, you can probably only access 10% of that equity. Lenders will never go to 100% on the loan to value ratio. So if you have 20% equity, most lenders will cap it at around 90%. So you need to have sufficient equity. You're going to need to have good credit. You don't need incredible credit, but you need to have, good credit, usually 680 or higher. And the reason for that is because the bridge loan is going to be in second lien position to the existing first mortgage. So it's going to be subordinate to the first mortgage. So because of that, it's considered higher risk, and the credit score requirements are going to be higher than what you would need on a traditional first mortgage. You want to make sure that you have consistent and stable income. Remember, it's possible you could have 3 mortgage payments, so you want to know what you're getting into. And then what we talked about earlier, you want to have a clear exit strategy. Usually the exit strategy for someone using a bridge loan is going to be to sell the property. But there can be scenarios where the property sits on the market. That happened to a customer of mine last year who got a bridge loan. Her property just sat on the market longer than anticipated, and she had options. There was a tremendous amount of equity in that property, but it was just on a busier street corner. And so she ended up having to, carry that bridge loan for upwards of 8 months before it finally sold. She eventually sold that property, and then at that point, the bridge loan was paid off. So just different things to think of and things that you want to be aware of.
So just to kind of wrap up, who's the best candidate for this, kind of like who wins and who loses with bridge loans? Sounds like, for buyers, anybody that needs to move fast in a competitive market, which we're starting to see kind of come back, hopefully, knock on wood. I've noticed a pretty big increase in just buyer interest in the last couple of weeks. But hopefully if that continues, just when it does become a little bit more competitive among buyers, being able to stand out among other potential offers that you're competing against. Mm-hmm. And one of the best ways to do that is to have any sort of offer without any contingencies, or at least minimal contingencies. Exactly. And one of those biggest contingencies is exactly this scenario where you're putting an offer on a new house that is contingent on mm-hmm. your current home selling. So I have some clients right now that we're kind of doing this exact strategy with the bridge loan, where by being able to have a bridge loan and basically put yourself in a position where you don't have to have a contingent offer, you're going to immediately stand out significantly above, any other offers that are out there if they're at a similar or same price point.
Yeah, that's exactly right. And the ideal winner and the ideal candidate for this product is going to be someone who is looking to move fast and write competitive offers. Exactly what you just said. You want your offer to stand out. You don't want to write a contingent offer. This allows that individual to go non-contingent. The second thing that you need is sufficient equity. So, sometimes I'll get questions where someone's asking me about a bridge loan, but they don't actually own a property. And so this is something I always have to remind folks. Like, you actually have to own a property and have equity in that property to be eligible for a bridge loan, because that bridge loan is secure to your existing property. And that's sometimes there's also some confusion there. So the lien is attached to the home that you already own. It doesn't go to the one that you're buying. So you have to already own the asset. Now, technically speaking, there are other ways that you could get bridge loans if you have other assets and stocks or bonds. Technically, brokerage houses will allow you to borrow against that in some cases. What we're talking about today is, residential real estate in the form of residential bridge loans, but there are other options out there. And then again, you want to have that clear exit strategy. Being in the mortgage and real estate business, and being very passionate about personal finance, the reason that most people don't win with their personal money and make good financial decisions is because they don't have a plan. They don't have a plan on their everyday financing choices. They don't have a plan for retirement. And when you're doing something like this, you want to have a plan. You want to know exactly what the exit strategy is. So you want to know what your options are. You also want to have, run some other options where, what if this doesn't sell on time? The way that I'm going to pay this off is by selling the property. Well, what if it takes 3 months to sell? What if it takes 6 months to sell? If it takes a year to sell, is that going to be okay? Am I comfortable making all 3 payments? If it doesn't sell, do I have the option of refinancing and consolidating both of those mortgages into fixed rate debt? Is that an option? So those are just questions that you want to ask yourself and be aware of, and also talk with a mortgage professional just to see exactly what your options are.
So we're recording this middle of February 2025. What's the current, range of HELOC interest rates right now? Are they above 10%? Are they like 10 to 12% or higher?
Yeah, depending on the bank and the institution, and depending on what they specialize in, like credit unions, for example, will have extremely competitive HELOC programs. I have used Belco in the past. I have a Belco HELOC on one of my properties. And the advantage of credit unions is that they are going to have lower interest rates that are not that far off, in some cases, what you'd be able to get on a first mortgage. So you want to do your due diligence and make some calls. Most banks, though, I would say that the interest rate is going to be around 2 percentage points higher than whatever the market rate on the 30-year fixed is. So if, as an example, if the market rate on a 30-year fixed is 7%, I would say that most institutions will, the rate will be somewhere 2 to 3 percentage points higher. And of course, things like credit score, the amount of equity in the property, the debt to income ratio, all of those things matter and ultimately can influence and impact the interest rate. But to answer your question, though, I think this is what you were getting at. Interest rates are usually going to be higher on a bridge loan or a home equity line of credit than what you would expect on a first mortgage.
It just made me think of something else that we had shared in a previous episode when we were talking just about credit and how to improve your credit score and just, how to properly manage money. I know we talked about HELOCs are also outside of the strategy of needing to purchase a new home and have this bridge loan scenario. A HELOC can also be a great option for people that might have some credit card debt that are maybe being charged 25 to 30% APR on a credit card. Using some of that HELOC money even to pay off a credit card. That is a positive, to be paying less interest. However, I know that you shared some really good advice on that previous episode about with any sort of, HELOC or a bridge loan, just being super duper cautious about only using that money to basically, follow that game plan that you've been talking about, not all of a sudden coming into this money and maybe we will go on that vacation that we've been talking about. I kind of like to upgrade my car. Like this is a slippery slope for people that aren't prepared with a game plan and have that financial literacy to avoid, going down that rabbit hole.
That's right. And that's such a good point. And I'm so glad that you brought it up because honestly, the statistics don't lie. Most Americans really struggle when it comes to financial independence and financial freedom. 79% of Americans live paycheck to paycheck or have less than a $2,000 emergency fund saved. And it's not because it's an income problem most of the time. It's because they're not making decisions on a daily basis that are consistent with building wealth. And so if you open a home equity line of credit, and here's the other thing to consider. A lot of times when someone hasn't saved a significant down payment, so say for example that you have a first time home buyer and they bought a home during COVID, and let's just say they put 5% down. And some of that 5% down, was a gift from their family. Those are all very positive things. I love that they bought a home, that they're first-time home buyers, that they got a gift, and they made their home ownership dreams happen. Well, 5 years later, they have $300,000 of equity in their property because their home has gone up so much in value. Here's the thing, though. They've never managed $300,000 before. So if you put a home equity line of credit on that with someone who has no experience managing that type of credit line, the temptations can be very great. And that's why you have to have the financial discipline, and you have to have the plan and the vision in place to know exactly what you're doing. Because if you have that plan and that vision, it's going to give that line of credit purpose. It's going to help you make responsible choices that are consistent with the vision and the plan that you have for yourself. So the biggest mistake that I see people make is they start off with wanting to do something like we're talking about, doing a bridge loan or something positive. But then all of a sudden it goes off to this tangent that they weren't even, I'm going to go buy a boat, or I'm going to go buy, I'm going to go upgrade my vehicle. That's not what this was about.
Yeah. I bet that happens a lot. So, well, before we move on to the next section, let's take a quick commercial break from our sponsored segment of the week, Roadrunner Property Care in Tucson, Arizona. Your property, their priority. So, are you a property owner in Tucson, Arizona, looking for hassle-free property management? Well, Roadrunner Property Care takes care of everything. Routine maintenance, security checks, guest management, you name it. Visit roadrunnerpropertycare.com. That's roadrunnerpropertycare.com today. All right, Ben. So let's just wrap up with a couple last questions that I have about bridge loans. We've talked a lot about just, when they make sense, talking a little bit more now about when they do not make sense. So you've spoken a little bit about just how they are a little bit higher interest rate, about 2% typically above the market rate at the moment. They are a little bit more short-term focused. So it's not a solution for, certain things. It's, a short-term type thing. You also talked about just carrying multiple mortgage payments at once and being financially prepared and, aware of if something sits longer than expected, the additional costs associated, and just being in a position where you can handle that extra load. And then just the market risks. If a home, like I said, doesn't sell, you're just gonna be stuck with those three mortgages. So just any market conditions that might pop up could make it more challenging than you're expecting it to sell the home that you're needing to sell to fulfill this bridge loan. I'd love just for you to maybe kind of walk through that breakdown of maybe dollar amounts for a second too, just to, I don't know, just give people a little bit more of like a different perspective on this.
Yeah, let me walk through an example, and I'm glad that you asked me that because there always is a lot of confusion on what mortgage is on what property. And so let's just walk through an example really quick. So let's say that we have a homeowner named Ethan. Ethan is currently a homeowner, and his current home is worth $500,000. Ethan has a mortgage on his existing property for $300,000. So he wants to go buy another property, but he's a current homeowner. Home is valued at $500,000, has a $300,000 mortgage on his property. So that's property A. Now he wants to go purchase property B, but to go purchase property B, he wants to put $100,000 down. Well, he doesn't have $100,000. So what he does is he calls his bank and he requests a bridge loan for $100,000. Ethan is well qualified. He has a good score. We know that he has sufficient equity in the property because his home is worth $500,000. He only owes $300,000. So there's $200,000 there in equity. He's only asking for $100,000. So the equity box is checked. He also has some reserves. He has some money in his retirement account. He does have some liquid funds and checking or savings. He also has a really great job, stable employment, and consistent income. And he has a debt to income ratio of in the 30s. So all very positive. The bank approves him for a bridge loan of $100,000. So that bridge loan is now on property A. So property A is the property that he currently owns. Valued at $500,000, first mortgage, $300,000, new bridge loan for $100,000. That's mortgage 2. So now he has the ability to use that $100,000 to then go put that down on his new property, which is property B. So property B is $600,000. So it has a sales price of $600,000. He puts $100,000 down in the form of the bridge loan, which is secured to property A, and he's able to close on the new property. So now he owns 2 properties, property A with the original $300,000 mortgage and then the $100,000 bridge loan, and then property B with the $500,000 mortgage that's valued at $600,000. He ends up selling property A 2 months after. He sells it for exactly $500,000, and in this scenario, we're going to keep the numbers simple. We're just going to say that there's no, closing cost or anything else. Again, just to keep the numbers simple. So he sells it for $500,000, property A. The $300,000 mortgage that was already existing is paid off. The $100,000 bridge loan is then paid off, and then he gets additional proceeds in the form of $100,000 that he can either put into his checking or savings or roll back into property B, which is now the only property that he owns. Does that make sense? Did I explain that all right?
Yeah, absolutely. I think that was very well said. So, that was something that would maybe be a 6 month. I mean, it's a short term again, guys, 6 to 12 months for that bridge loan. So in that example, that worked out perfectly for them.
Yeah. And keep in mind that, one of the risks that we didn't touch on, the interest rates are usually going to be a little bit higher. You have an additional payment that's going to impact your monthly cash flow. But bridge loans, because they are normally home equity lines of credit, they are usually going to be variable rate. And so that rate can adjust. Now, the loan amounts are usually going to be smaller, so there's going to be less risk there. But if you do have a variable rate bridge loan, it would mean that the interest rate can adjust on a monthly basis. So depending on the overall market conditions as it relates to not just housing marketability, how quickly homes are selling, but also what's happening with interest rates, again, something that you just want to be aware of.
And the one last point I'll make regarding the interest rates is also just important, you guys, in case you didn't pick up on this. You're only paying interest on the amount of the home equity line of credit that you're using. So if you have $100,000 line of credit, a home equity line of credit, and let's say you have to only use $60,000 for that down payment on the new property, you're not paying the higher interest rate on that full $100,000, only on whatever amount you're using. So that's also a great thing. A lot of people, that are thinking ahead and being very proactive, like Ben mentioned at the beginning of the episode, get these set up, maybe even, immediately after, refinancing their home, or just within maybe a year of purchasing it. Ben, I think there is a requirement. You have to have the home for a certain amount of time before you apply for a HELOC, right? Is it 6 months or a year?
It depends. If you're using a value that is higher than the sales price, sometimes lenders will have restrictions on that. But say, for example, that you put 50% down, and I've told customers this: go put 50% down in your purchase, because that's what your goal is. You want to put a large down payment. Immediately after that, go open a line of credit for as much as you can. Not so you can be irresponsible, not so you can use that to finance your vacation, but so you have financial security. It's just another tool in your financial tool belt. It's another part of your wealth building plan that you can incorporate. And if there's an opportunity that comes up and you need to access exactly what we're talking about, if you need to access some money for short-term purposes, you have the ability to do that. Because when opportunities present themselves, a lot of times you have to jump on them. And if you can't jump on them, they're going to pass you by. So I'm not saying that to go be irresponsible. I'm saying that so you can have your wealth building goals in mind and be able to take advantage of those opportunities. But then guess what? If you're not using the home equity line of credit, let's say that your limit's $300,000 and you're not using it, you don't have a balance, you're not paying anything. A lot of times there can be an annual fee of $50, $65, $75 that you pay once a year to keep it open. Fine, big deal. Who cares? But you're not paying interest if you're not using it. So there is no reason that I believe if you have equity in your property you need to have a home equity line of credit secure to that, where you can access your home's equity for whatever reason at any given point. And let me just wrap this up really quick. I want to make one last point. And this is this is more on the home equity line of credit theme than it is the bridge loan. I get a lot of calls from folks who have had that life event happen. They had that health concern that popped up. They had a loss of income or a loss of employment, and then they're calling me, telling me they need access to equity out of their home. Well, I can't help them at that point a lot of times because they had to take a leave of absence from their work. They're no longer working. They lost their income. And if I can't qualify you, then I can't help you. And so that is why it's so important to be prepared in advance. You need to get access to the money when you don't need it. So when you do need it, you have access to it. Because if you're not prepared, you're not going to be able, you're going to be in a really, really difficult spot.
And just how much value is there in just having that peace of mind, laying your head down at night and just knowing that if that life event or just unknown thing does happen, that you just have that already set up where you're going to be okay, as opposed to being reactive and calling up the bank after the fact and getting denied, or just, it just sounds stressful just hearing you talk about that. So
the amount of credit that I have set up for myself, like if I told you, I not only do I have credit cards, and again, all of the credit that I use and that I have is used in a very responsible way. My credit cards, I do not pay interest on. They are paid off every single month. I have an unsecured line of credit with Wells Fargo. I have a home equity line of credit on my primary residence with Belco. I have a home equity line of credit on a secondary property with North Point. I have an all-in-one mortgage, which is a line of credit on an investment property. I have a second all-in-one mortgage. So, including my credit cards, I have over probably 15 different lines of credit. And exactly what you just said. Right now, this is a really challenging real estate market. It's a difficult mortgage market. But when you have access to, if I have a difficult month or a difficult quarter, or if there's issues with the investment properties, I still have access to be able to use the funds when I need them if something did come up, if there was some type of emergency. Last year, for example, one of my investment properties in Tucson, I had to replace the entire roof out of pocket because the roof exceeded its livable duration. I tried to file an insurance claim. It got denied. So I had to replace the roof out of pocket. I can either, use my personal savings, or I can go use my line of credit to pay for it and then pay myself back at my own pace. And so that's ultimately what I'm talking about. You have so many more options, flexibilities, and you're going to be able to sleep better when you have a plan in place and you set it up correctly.
Love that, man. Very inspiring and just great advice for pretty much everybody out there. So nobody can, deny that just having that peace of mind is incredibly valuable. And the older you get, I think the more anxious you become on some of that stuff, and even more valuable it is. So
yeah, I think sometimes people get a little bit spooked though, because they don't always understand this stuff, and it's so foreign, and it seems a little bit scary.
Mm-hmm. Yeah, I get it.
And that's why it's so important just to really understand what you're trying to do and talk through it. And, don't get advice from someone who's not doing what you're doing. So don't get advice from someone who's not a real estate investor about real estate investing. Talk to a mortgage professional or a real estate professional who understands the type of transaction you're looking to qualify for to get some really meaningful advice.
Love that. Well, you guys, with that being said, hope you guys got some good value from this one today. Again, just talking all about bridge loans, home equity lines of credit, just how that value of that flexibility, but also how they really do require strong financial planning and financial literacy. So obviously they work great for different markets, but especially right now in these competitive markets, especially what's going to hopefully turn into more and more as the next few months and years to come, when more and more buyers are getting into the market and it's becoming more competitive again. Thinking very optimistically here. But again, guys, just a great option for a lot of different reasons. So if you have any questions that you want to get a little bit more one-on-one with on this, feel free to reach out to Ben. He's a great resource. We'll always have his contact info included in the podcast notes, or you guys can always just look us up on social media as well. And with that, Ben, I hope you guys have a great rest of your week. And we look forward to sharing an all new episode of the Pursuit of Progress podcast with you soon.
That's right. Love you guys. We'll see you next week.
See you guys.